What is happening, guys? Hope everyone is having a good week, enjoying the nice weather. I mean, what the hell are you doing listening to this video when the weather is so nice outside? Just, I don't even know what I'm doing, so I'm in the same boat as you. But today I'm going to be taking you through a Buffett style approach into the interpretation of Penn's last 4 years Q1's financial statements. I'll be noting issues that I find within the Q1 earnings reports, and essentially what you should maybe think about before entering into the stock. As I say, you can probably tell by my poor software, etc., my poor audio, that I am not a financial advisor. I'll just leave a referral link in the description in regard to the Warren Buffett and the Interpretation of Financial Statements book. It's essentially the holy grail if you're sort of as an introductory book to value investing and as to what you should be looking at in terms of financial statements. Just so you know, I would be getting a sort of commission if you were to press through the link. It's no problem if you don't want to go through that route. The first thing we'll note here is that the depreciation is slightly high. Depreciation is essentially the wearing out of assets such as property or machinery over time. In this case, Penn spends 17% of its gross profits on depreciation. Warren would ideally be looking for a figure of 15% or below. I think it is fair to say, however, that this is still a sort of decent depreciation percentage. However, in terms of when we're looking for a company with a long-term competitive advantage, we do need to be sort of nitpicking these type of things because it can catch up on us. Let's move on to net earnings. Net earnings is essentially how much money the company made after taxes and all deductibles are dealt with. Penn's net earnings are currently sitting at only 7% of their revenue. This is not great, and they do have a history of having quite a low net earnings when compared to their revenue. If we look at 2018, it had 5.5%, 2019, 3.1%, and today, 7%. Warren believes that companies with a durable competitive advantage report high percentage of net earnings to total revenue. It's important to note, however, that this is albeit sector specific, and this is a figure that should be compared to the company's competitors. However, we are still only sitting at 7%. From this 7% figure, we may make a conclusion that this means that the sector that Penn is in is either too competitive, meaning no one company can really get a sort of durable competitive advantage alone. Thus, one should question the company's competitive sustainability. We want to see a figure, ideally, of at least a 10% consistent growth in net earnings. This shouldn't just be one sort of year, 10%. This should just be a consistent growth annually of 10%. Let's move on to earnings per share. As you can see, the numbers here are quite sporadic. They're very much varied. This is not a good sign at all. It's not actually a bullish trend whatsoever. A trend such as this one, where there's not really any consistency in the growth of the EPS, is something that Buffett would generally stay away from. I'll show you an EPS trend which is a lot more bullish than the Penn National Gaming EPS at the moment. An earnings per share with lots of boosts and busts, such similar as to the Penn National Gaming one, means the competitiveness of the industry is fierce and is prone to fluctuations. Now, I think this is very important to note, especially during the current climate, that the massive swings in price caused by changes in earnings create the illusion of buying opportunities that may seem appealing to the traditional value investor. However, this is generally a slow train to death. There will be rallies in price, however the company will usually hit a downtrend. This is definitely something to note when looking at the current price as being undervalued. I see that that's pointed around everywhere. The value, as I say, I'm not a financial advisor, so it is a subjective outlook you should have. However, I think it is something to note that just because something says it's undervalued does not mean it actually is so. Now, let's move on to return on assets ratio. Penn currently has over $14 billion in total assets. However, the current return on assets ratio is 0.6%. This will generally tell us that the company has poor efficiency in putting assets to use. We want to see a figure here of over 5%. Like if we look at one of Buffett's investments, Procter and Gamble, it has $143 billion in assets and a return on assets of 12%. We can just use that as a perspective here, just to compare to Penn's 0.6%. So overall, I think this is something that Buffett would maybe would look negatively upon. Now we come to long-term debt net income. Buffett looks here for companies that can pay off long-term debt within 3 to 4 years using net earnings. The company has currently over $2 billion in long-term debt with a net income of 90,900,000 per the first quarter. If a company were to keep this net income rate going for the year, it shall take over 6 years to meet their long-term debt. This is still speculative, as I say. I'm just sort of using the Q1 trend to work out what the annual net income will be. Still difficult to tell. However, at the moment, they're not moving at the right pace to cover this sort of to cover the long-term debt in the space that Buffett would be looking for. Now we'll move on to retained earnings, and I know this is something that Buffett puts a lot of emphasis on. I definitely think we should be looking at this in detail. Retained earnings refers to the historical profits earned by a company, minus any dividends it paid in the past. The word retained captures the fact that because those earnings were not paid out to shareholders as dividends, they were instead retained by the company. A negative number indicates a risk of bankruptcy, as it implies a long-term series of losses, and unfortunately Penn's retained earnings is currently negative 416,300,000. Now, let me be clear, I don't see any sort of issue with Penn and going into bankruptcy anytime soon at least. They have solid cash and cash equivalents to more than cover any sort of current liabilities. They do maybe need to pick up their net income just to be more than safe to cover their long-term debt. However, I still don't see any problems with Penn and covering debt. Negative retained earnings do harm the business, however, and that should be noted. It's something shareholders should be concerned about, as it stunts the company's ability to be able to pay dividends. And I think it is quite alarming when an established business such as Penn is consistently running with negative retained earnings. I mean, let's just look at the annual figures here. 2018 through to 2021, they had negative earnings, retained earnings every year except 2019. However, that is pretty much shadowed out by the other years around it. Now, it can be argued that the negative number is in relation to a changing business. However, it's something that Buffett puts massive emphasis on, and it should not be ignored. I can't help but think, this is something that Buffett would definitely turn his head off, would make Buffett definitely turn his head round from. Finally, here, Penn has a very low return on shareholder equity. It's currently at 3.2% in 2021, thus indicating a highly competitive industry and indicates that Penn is not making good use of their earnings. Look, I could give you any figure in the book in regard to Penn, and it's still not going to determine how the stock's going to move. Anybody that tells you that they can predict the future and how a company is going to move is either two things: one, mentally insane, or two, just a complete rookie at the market. If Penn is something you genuinely believe in, invest in it, I would say. I mean, is it for me? I'm not even sure yet. I'm gonna maybe wait till till the annual report's released to make my actual final decision on whether I'm gonna go bullish in the stock. That would be sort of for a long-term investment. However, now I'm just gonna stay away from it. I know it is still undervalued, but I just don't think I've got enough evidence to put myself in towards the stock just yet. Now, it should be noted that I do have a soft spot for Sydney Rains. Dave Portnoy, sorry. So yeah, I think that is definitely something that will guide me toward the stock if I were to go for it in the future. And I think Dave Portnoy can carry us all to the top, baby. Looking at Dave, honestly, all I can see is a horny white guy, and I'll just be honest, I love that. And I mean, I think that's all you need for a successful multi-billion dollar industry to grow. So, let's go. Now, all that aside, thank you very much for watching the video, and please, if you could like and subscribe, because this took me far too long to make. But yeah, no, I appreciate it. I really enjoyed making this one, and hope everyone has a good week. See you later.